Hello Sector Watchers, welcome to the show. This is the 189th episode of Sector Spotlight for Monday the 21st of August. My name is Julius the Kempenaer and I'm presenting to you from Amsterdam in the Netherlands. We're going to take a look at sector rotation, but this week I would like to take the angle of comparing cap-weighted versus equal-weighted sectors and see if we can find any material or significant differences that we can use to our advantage. Ladies and gentlemen, this is Sector Spotlight. As promised, we're going to take a look at the comparison of cap-weighted and equal-weighted sectors for the S&P 500 side by side. On the left-hand side of the screen, we have the cap-weighted sectors, the RRG that you are hopefully very used to. And on the right-hand side, we have the RRG showing the rotation of the equal weight version of those sectors. It's the same group of sectors. The only difference is these are based on equal weight weightings, and on the left-hand side, they are cap-weighted weightings. So with the larger cap stocks dominating and being more important and obviously driving more of the rotation. Let's try and see if we can, when we compare the tails for every sector, if we can find meaningful deviations and potentially tradable information. Let's put it like that. Well, the first thing I'm going to do to have them side by side is sort them by name, because now I can actually go through the list and make sure that on the left and the right hand side I have the same ETF, the same sector. You can see that the overall picture, so here is the cap-weighted version that's compared against SPY, of course, I would say. And on the right-hand side, we have the equal weights, and they are compared versus RSP. That's the Invesco equal weight S&P 500 ETF. You can see that the bigger moves are kind of similar, so the moves of the tails, but there are definitely some subtle differences. Let's go over them one by one. So here is communication services. And what you see is that the cap-weighted version is still inside weakening, and it's actually already starting to move up a little bit, while the equal weight version is just about to cross over into the lagging quadrant. That tells me that the larger cap communication services stocks are actually doing better in this case. So they are leading because XLC is actually, it looks as if it's ready to curl back up, whereas the equal weight counterpart is moving into the lagging quadrant. So here everything is the same, and here the large cap stocks are more pronounced and they are doing better. So the translation of the comparison is that the large cap communication services stocks are doing better. They are leading the communication services sector. So that's one thing. Let's move to consumer discretionary. And here you see the tail of XLY moving almost vertically lower, signaling a loss of momentum, a quite significant loss of relative momentum. And if you look at the equal weight counterpart, then you see that the tail, first of all, is much shorter. I'm scrolling back through history right now, so here you go. You can see how this tail is way shorter than the one for the cap-weighted. The direction is, RSPD is moving a little bit further to the left, but the fact that the tail is very short means that it is a pretty stable relative uptrend that goes through a bit of a corrective move. If you look at the tail on XLY, this suggests that especially the larger cap discretionary stocks are now losing relative momentum, because that's why that tail is a lot longer and it's moving faster than its equal weight counterpart. So where we had the large cap stocks in XLC doing better than the, let's say, mid and small caps or the smaller cap versions, the smaller stocks in communication services, you see the opposite in XLY, where the major or the more important stocks are losing momentum more rapidly than on an equal weight basis. So the large cap part and XLY is losing out more rapidly. We go to the staples version, then it's the opposite. Here you can see they're both inside the lagging quadrant, but the XLP, so the cap-weighted version, is rapidly picking up relative momentum, whereas the equal weight version has a lot more trouble to pick that up. It's picking it up a little bit, but XLP is definitely leading. So in the consumer staples sector, the larger cap names are improving faster. That's the takeaway of this comparison. We go to energy. That's probably the most disconnected, well, not really, because the tails are actually in similar fashion. They are quite long. They're the longest on the plot, both sides, which means that it's a powerful move. And the cap-weighted version is inside improving, but improving rapidly. And in the equal weight version, they're actually already leading. So if you want to make a comparison here or make a judgment call, I think that the smaller caps, or the smaller stocks in the energy sector, are leading the larger caps, but they are following suit. Now, financials. Cap weighted, equal weighted. I am going to call that a tie. Both are inside the improving quadrant, both are at a pretty good RRG heading, and they're moving to the right, so they're picking up relative strength. So XLF and RSPF, cap weighted versus equal weighted, pretty much on the same track. Here's healthcare. Here you see, again, a clear difference. Cap-weighted XLV is already inside improving and started to pick up on the RS ratio scale, so starting to move towards that lagging quadrant. If you look at RSPH on the equal weight version, it's still inside lagging and still moving to the left on the RS ratio scale. Picking up a bit of momentum, but still moving on the left, so it's still losing relative strength. So here, XLV is clearly in better shape than RSPH. Again, the translation here is that the large cap healthcare stocks are driving the sector higher. Obviously, they will also have an impact here, but it's the large cap healthcare stocks that are driving XLV higher and outperforming RSPH. Industrials, and that's an interesting one because, as you know, industrials was the sector that broke out to new highs, still holding up there very well, but you can see that the tail on the RRG is starting to roll over. It's a weekly tail. So for the last 2 weeks, performance is slacking a little bit. It's starting to falter. If you look at the equal weight version, that's in much better shape. It's way to the right. It's actually, when you can see, this is actually the highest reading RS ratio on the equal weight version. So that's pretty good. But it's losing relative momentum. But here it's losing relative momentum while in an uptrend. And here on the cap weighted version, it's starting to lose relative momentum while in a downtrend. I can still make a pretty positive case, but it looks as if the equal weight version is actually doing a bit better because it's already going through that rotation, and it's way higher on the RS ratio scale compared to RSP. So on an equal weight basis, the larger names inside industrials are underperforming the rest of the group. Materials is just like financials. I'm going to call this a tie. XLB is inside improving, nice RRG heading, picking up in relative strength. RSPM, inside improving, picking up on RS ratio, both doing pretty good. And real estate, here you can see both are inside the improving quadrant. XLRE is actually still pushing higher at a strong RRG heading, and RSPR has just rolled over. And you can see also the difference in tail length for RSPR versus XLRE. RSPR is a very short tail, indicating a stable, in this case, relative downtrend, because it's on the left-hand side of the RRG. And you can see how XLRE is actually improving and accelerating further into the leading quadrant. So the takeaway from this is that the larger XLRE stocks, the larger stocks inside XLRE, are leading the group. They are doing better than the rest of the group, than their smaller cap, mid cap, small. I don't know if whether you could call that mid cap or small cap, because they're all S&P 500 stocks. But the more dominating stocks inside XLRE are driving the group higher. So that is the group where you should focus. If you want to translate that into an investment decision, I would say that I would focus on the larger names inside XLRE to put into my portfolio. And then technology. And that's interesting because both the equal weight and the cap weighted version are showing a similar picture. So the weakness, the relative weakness, as we've seen over the last few weeks from the group technology stocks, is similar inside equal weight and cap weighted groupings. So no, not necessarily the bigger stocks leading the decline. It looks to be sector-wide where we see that loss of relative momentum. Both the tails in RSPT as well as XLK are moving into the weakening quadrant, well into the weakening quadrant, and they're losing on the RS ratio scale. However, both are still way on the right-hand side, so there's still a good possibility for the technology sector to curl back up and move back to the leading quadrant in both the cap-weighted and the equal weight versions. And then finally, we have the utility sector, and as you can see, both sides are inside the lagging quadrant, but you can see the improvement for XLU. That's about to cross over into the improving quadrant with a pretty long tail pointing upward, indicating that there is a rapid gain of relative momentum. Not so much RS ratio yet, so it's still in relative terms, a weak sector. It's still in a relative downtrend, but it's going through a bit of a momentum uptick within that downtrend. If you look at the equal weight version, if you look at the equal weight tail, that moves inside the lagging quadrant and actually picked up and now started to move to the left again. So it's already again losing that little bit of relative uptick, relative momentum uptick that we had here. It's already losing that and moving lower on the RS ratio scale. And again, if we looked at in comparison, it is the lowest reading inside the equal weight group on the RS ratio scale. So here, from both angles, the utility sector is still in a relative downtrend, but the larger stocks inside utilities are showing a better move higher, showing a move faster higher, indicating an outperformance for the larger name in that group, larger names in that group. But don't be mistaken, the entire group is still in a relative downtrend. So I wouldn't be too keen on adding utility stocks to my portfolio. But if you are let's say a professional fund manager and you have to have an exposure to utilities, even if that means being underweight utilities, your better bet is to look for the larger names inside the utility sector. So this wraps up the comparison on the RRG. I want to now go to do some side-by-side comparisons of a few of the more important sectors, or at least the sectors that are showing the biggest differences between cap-weighted and equal-weighted tails. Now that we've looked at the comparison of the tails, I want to go ahead and take a look at 4 sectors side by side, cap-weighted, equal-weighted. Let's start with the most striking tail probably for the energy sector. So it's, to recap, inside improving on the cap-weighted version, highest RS momentum reading, and well inside the leading quadrant on the equal weight basis, and here also highest momentum reading. So there's no doubt that the energy sector as such is a good sector at the moment. In both cases, cap weighted and equal weighted. If we look at the individual charts, then you can see that they're, that's always the case. They kind of look the same, but when you start to look a little bit closer, there are quite some subtle differences from time to time. And the one that immediately strikes me here on this energy sector chart is that the highest point in the chart for the cap weighted version is in November, and for the equal weight version it was already set in June 2022. And if we look at the the current position of this sector in relation to its previous highs and lows, you can see that the equal weight version has just kind of bounced off the peak that was set in January. And if you look at the cap weighted version, it took out the April high, but it has not reached yet, or wasn't able to reach, the January high. So that to me is an indication that the equal weight version is a bit stronger than the cap weighted version. And we look at the RRG lines, the raw relative strength looks quite similar, but when you look at the subtle differences that are magnified by the RRG lines, you can see that the equal weight version is already pushing into the leading quadrant with both RRG lines above 100, and the cap weighted version still needs some work. It's still inside improving, but it needs to rally. So from that point of view, I can argue that the energy sector, the better part is the equal weight. So the not necessarily the large cap names inside the energy sector. The second sector that I want to take a look at is the consumer discretionary sector. And this is actually, there's a little bit more differences here if you look at the chart. Quite clearly, the rally at the end of 2021 was way stronger for the cap-weighted version. There was a little bit of a rally here in equal weight. And then we had the decline, kind of similar. But out of the, let's say you can see that the cap-weighted version dipped to a new low just before transitioning into 2023. That didn't happen on the equal weight. As a matter of fact, it was way different at the time. Look at the difference here. Let's take that October low and look at the relative strength line and the RRG lines on this chart. And then we go to the October low here on this chart, and now look at the relative strength and the RRG line. So they're pointing sharply down, whereas the equal weight version was already picking up and almost crossing over into the leading quadrant. And we had a little bit more strength in the cap-weighted version very recently. You can see that both relative strength lines are moving higher, but the cap-weighted version is a little bit steeper than the equal-weighted version. And the result of the recent decline is that it looks a little bit more aggressive on the cap-weighted version, whereas the equal-weight version remains in a stable trend. You can see how that RS ratio line remains kind of sideways, and the green RS momentum line just oscillates around 100. That indicates a pretty stable trend, and I think that's the biggest difference that you can see between the cap-weighted and the equal-weighted charts. So the consumer discretionary sector, that is. If you look at the staples version, that's interesting. It's quite the opposite. Here also you can see that there are some differences when you look at the position of the highs and lows. Most notably, if you look at the equal weight version, it's now just about to break. Well, it's breaking below the March 2023 lows. And it already took out the end of May lows. Now look here, the cap-weighted version is still trading above the May low, and it's not even close to taking out the March low. So that indicates that the equal weight version of the staples sector is actually a lot weaker than the cap-weighted version. So cap-weighted, just if you only look at the position of the highs and lows, cap-weighted definitely beats equal weight. And that's translated into the move of the relative strength lines, especially in the latter part of the move here. You can see how RS momentum is picking up on XLP, putting in a low here, whereas on the equal weight version, RS ratio is still pointing straight down. So in both cases, let there be no doubt, consumer staples is a weak sector versus the respective benchmarks. But when you need to make a comparison, I think that the cap-weighted version actually beats the equal-weighted version. And the last sector that I want to talk about is the technology sector. And you can, just by looking at the positioning of the highs and lows relative to each other, you can see that the cap-weighted version has done a lot better than the equal-weight version, especially during the last year, definitely. If you look at the move, then you can see that technology has actually taken out the previous high that was set in December 2021. If you look at the equal weight version, that hasn't even come close to that level. Both have been breaking out a base formation, there's no doubt about it. So, in any case, the technology sector, both cap weighted and equal weighted, it's actually looking pretty good and pretty strong, going through a corrective move. If we want to make an assessment on what the stronger correction is, or maybe the most interesting area to pick up on, we need to make an assessment of the relative strength against the respective indices. And you can see that the relative strength line of XLK actually pierced above its previous relative highs and is now sort of finding support at that previous high. If you look at the relative strength of the equal weight version, that hasn't even come close to taking out its relative highs that are dating back to the start of 2021. If you look at the RRG lines, then both are inside the weakening quadrant, but the RS ratio reading for XLK is way higher than it is for RSPT, which is the equal weight version. So I would argue that the XLK, the cap-weighted version, is actually the stronger one because it has a higher RS ratio reading, and with the steepness of the decline in momentum, XLK seems to be closer to turning back up inside that weakening quadrant, pick up new relative momentum, and potentially moving back towards that leading quadrant. And while I was recording this show and going over the various tails and showing you the RRG for the cap-weighted sectors and the RRG for the equal-weighted sectors versus their respective indices, and making my assessment of which area, so the larger cap, basically what you're doing is you're looking whether the driving force in the sector is the larger cap names or not the larger cap names, i.e. everything else. It actually dawned on me, like, how would it be if we would not look at them like that, but if we could put that on top of each other and look at the ratios. So look at every individual sector, like XLE compared to RSPG, and plot that on an RRG. And I had to think and I had to test because I wasn't really sure whether it will work, but it does. So what I did is I set up an RRG here where the symbols are the ratios of the various sectors. So XLY against RSPD, XLE against RSPG, XLI against RSPN, etc. And the benchmark here is RSP, that's the equal weight version. So what we're looking at here, and I need a little bit of time to digest it. Please replay this, recapitulate it, recreate this chart. Actually, what I'm going to do is I'll put the link to this chart in the description of the video so you don't have to recreate it yourself. This is one of the situations where you actually look at the chart and you need to think like, what am I really looking at? Once again, we're looking at the ratios of the various sectors, cap weighted versus equal weight, and compare that to the ratio of cap weighted versus equal weight stocks in general, so SPY versus RSP. And interesting enough, what you see here is that the tails that are moving lower or weakened. And actually when I scroll through history, it's interesting because you will see the rotational character of these tails as well. It's quite fascinating, I've got to say. You can see how the weakness of these sectors here. So, and it's interesting that right now inside or on the right hand side of the graph are communication services, technology, and consumer discretionary. And these are arguably the bigger sectors in the universe. And they are all coming out of a leading fashion. And as I said, I needed a little bit of time to process this. But what I think that this very clearly shows is that the driving force of the large cap names in discretionary and technology, and to a lesser degree in communication services, has now rolled over and moved into the larger cap names inside the other sectors. So for XLY, XLC, and XLK, the dominance of the large cap stocks is going through a bit of a correction. And I need to look at my notes because I realized that it isn't exactly the same as what I said when I did my assessment. But I think this gives a little bit more color to the rotations. It definitely aligns with my view on consumer discretionary, where I said that equal weight is now handsomely beating cap weighted. I was kind of on the edge for technology, and I think this one shows that equal weight is now beating cap weighted because it's still moving lower. And you can see how communication services is actually starting to pick up again. And I had communication services cap weighted over equal weight, and that looks to be kind of the same. All the others here, it looks as if the cap weighted stuff is picking up. It's gaining strength over equal weight. And that's an interesting comparison. It's an interesting observation, at least I think it is. Especially because it underscores or it visualizes the rolling over of the large cap stocks inside discretionary and technology. We all know that they've driven the market up, and they're now driving the market down, and these ratios actually visualize that almost perfectly. Now, because this is a combination of looking at a ratio against another ratio, so these ratios against that ratio, I'm not sure about you, but sometimes my head starts to spin and I need to think like, what am I actually looking at? What is this? What does this picture tell me? So what I also did is I took the same image, but I changed the benchmark to $1. And as you know, that makes it an absolute price performance graph. However, as we're still looking at the ratios, we're looking at these ratios, these relative strength ratios against each other and against, a straight line benchmark. So you get the absolute price performance of a ratio. You still with me? The interesting thing is that what you can see here is that XLY, XLK, XLC, the big ones, are rolling over. To a lesser degree, you see that it's happening with materials, XLE as well. But the interesting stuff is that the really good ones, and they're a little bit harder to pick up here inside that cluster of blue, are actually consumer staples and healthcare. And that's obviously a little bit more of a defensive play. So combining these two underscores my idea that the driving force of the large cap stocks in the big sectors, consumer discretionary, technology, to a lesser degree, communication services, is now making way, handing over to the other areas of the market, to the other sectors and to the not necessarily large cap stocks. And when we bring that then to the comparison of cap weighted versus equal weighted, and we look at the relative strength of SPY versus RSP, then we can see that for a long time, equal weight was outperforming cap weight. That's what's happening here. SPY underperforming RSP. And that move has now changed. It's now moving upward. And we go through a little bit of a correction. And this little dip here is being picked up by those RRG lines. And I would argue that when you look at a move like this and an RRG line that is kind of putting in a new higher low and trying to move higher, that'll take a little bit of time before the RS ratio line will put up a new low above 100, re-establishing an outperformance of SPY over RSP. So a move back to the larger cap names, a move back to cap weight dominating equal weight. If I need to put a timestamp on it, I'd say in the next, I don't know, 4 to 6 weeks. And this wraps up Sector Spotlight for this week. Thank you for watching. I hope you enjoyed the show. Please let me know in the comments what you think about that last use of RRG with the ratios versus the SPY RSP ratio or versus $1. I'd love the discussion and see if anyone's got any great ideas about that. As you know, Sector Spotlight is available on demand on the Stock Charts YouTube channel, usually recorded and uploaded on Mondays. Feel free to share your thoughts and ideas in the comments below the video. Thank you very much, and I'm looking forward to seeing you again next week at a new episode of Sector Spotlight, same time, same place.